throw the word blockchain in like it's some magic unicorn, but the assets are sitting in the vast majority of circumstances on a central exchange because
we came up with this slogan that I shared this morning as well, the decentralized capitalism. For
Mhm,
us, that made sense because we think in the future everything should be decentralized, right?
mhm,
Capitalism is the start of things, but I think over time, science, health, pharmaceutical, all the industries we think will be decentralized, right, in some shape or form, which again goes back to, what does decentralization means? It might mean different things for different people, but for us, at least, it means, it needs to be open, accessible, and transparent, right? It
mhm.
has to be those three things across all industries. And we thought we just want to bring that content forward, things that are now bubbling up to the surface, right? They're just starting to bubble up. They're not quite there. And not many people actually they're discussed on the very surface level. We want to go beyond that. We are saying, well, what's happening beyond that? Why it matters to us? Why we are passionate about it? Let's bring all those experts that are in the industry. You've been building this blockchain-based transfer agent, right? Let me repeat: blockchain-based transfer agent. It's not a broker, and you've been going on this path, on this journey for the last 4 years, if I'm not wrong, right? It's called block transfer. And for me, I care about it. I think it matters because you're one of the experts in this field, right? There are a lot of experts, right? You go to crypto community, there'll be everyone is an expert in price action, everyone is an expert in blockchain, but we are not here to discuss price action. I'm here
Price action. Now you're talking my language.
I am here and you're here to discuss why these things matter. So let's get into it. I love the intro. Let's get into it. So I wanted to hear straight from you, right? Being in the industry and being in this field, building a transfer agent. What is BUIDL, right? Why BlackRock is jumping into BUIDL, right? I've watched all the interviews. I've seen everything they're discussing, they're putting out there. But yeah, I think I wanted to share my experience as well, my story, learning this BUIDL stuff. So let's have a dialogue here rather than just one way interview.
Sure. So I've learned about BUIDL. I went to it back when I was finishing up. I graduated Georgia Tech, but my partner was finishing her last year of school, and I went to these blockchain meetups in Atlanta. And it was, and these were very heavy, institution-based meetings. They were like the Coinbase venture guys that invest in these crypto startups and turn them from tokens into some centralized equity sort of superstructure. Were some of the people that would talk there. And it was a tremendous local grassroots community focusing on really building blockchain. But I could tell, and something I've seen really throughout the industry, it's something that pushed me away as someone who started learning about Ethereum, as we established last time at very early stage. I think that addressing Ethereum at the start here is going to be they have done very stellar research, tremendous output, and really put something together from ground zero that didn't exist before. To think that they were in very, very early years conducting an IPO with Bitcoins or an ICO and then decentralized. I mean, what they did is very impressive on a technological and infrastructure front. But unfortunately, over the years, over the decade of its existence and the growth of that community, while it has produced absolutely phenomenal research, and they really have pioneered so many incredible concepts.
I think BUIDL, I came across that early in the year, right? So it was a hot topic for a minute in March, April, when it, I think, got launched on Securitize. And then it sort of disappeared because now AUM is growing. Like I think the last time I checked, it was over $500 million, 550 or something. Started from 100 million, right? So first time I heard was just across Twitter X. It was someone mentioning that hey, BlackRock is getting into this money market fund through tokenized way, launching on Securitize, which they end up doing. So it was it was like, okay, there's something happening, but no details why it matters, why they're getting into it, what um, assets they're going to hold. None of that was there. And then you get into your own research and you start to find out, oh, well, it's actually interest bearing asset. It's going to be holding it's going to be holding treasuries, which are obviously interest bearing, and they're passing all the interest over to the holders. It's an institutional grade asset. Only institutions can hold it. So I think, yeah, when you do your own research, you start to see, well, this is sort of early beta, really. They're testing the grounds, but it's going to be something much, much bigger. And they themselves are saying that, right? It's not just something we are speculating here.
That sounds like it was just a big press release, a big news wave that brought it into your life.
Yeah. What's your take on BUIDL now? I think we all know the basics, right? It's a money market fund launched on securitized.
Yeah, and they do the man. I don't know if you've ever tried to manage treasuries through like Treasury Direct, and I'm sure it's leagues more complex for your situation. But even as an American citizen trying to get into Treasury Direct, it took me 8 months to establish an account, and then I got locked out of it in a week. And I've been able to access it. They'll like mail you a password, and then you have to sit on the phone for 2 hours, and then you have to get a notary to open an account. It's unbelievable the barriers they put for retail to access these underlying Treasury securities. And I think that ethos is such a foundational part of the story here with BUIDL that relates expressly to the ATS side, to the T0, to these intermediaries that inject themselves into the trade quite often for the sole purpose of extracting. We talked about the transfer agent in this instance, 1% trading fees on every transaction. And that's why the biggest question for me when we talk about these assets just to get it in the air and out in the open. Okay, Franklin Templeton was doing this years ago on Stellar. They would let you download an app on your phone. You could deposit through your bank account right into there. You could buy their money market fund. It was an open-ended fund, quite similar, fairly similar. It was much more regulated than BUIDL, and it was established up to the standard of what you would consider to be a proper mutual fund with actual expense ratios and a tangible redemption market based on thousands of years, all these years of mutual funds. And that is something that I see starkly different when we look at these BUIDL tokens and generally the approach of certain securities on these more mainstream channels. In this instance, how was this offered? It was offered through a Form D. It was offered through a Form D with a 3A7 exemption, which means that only people worth 5 to 20 institutions, $25 million or more have real access here. And again, these aren't assets that we're trading on Uniswap. They are only in this central select group of for-profit intermediated exchanges. And to see now this narrative being pushed that all these other centralized exchanges need to use this as their collateral token, it just looks like something built for institutions, by institutions, and quite frankly, at the expense of retail, who doesn't have access. There's but they have one filing, one SEC filing for the Form D. There is no transparency or accountability, and frankly, just something happening, in my view, behind closed.
But tell us first the process they went through.
Well, I've got the filing up right here. They put this separate organization under the parent of BlackRock, which in itself is this mammoth, as we know, centralized asset management institution with direct ties to institutional. And it is an uncapped Form D. So it's a Form D is what you use for private placement. If I'm a startup selling you shares, that is the least regulated activity. A Form D is just claiming that I'm giving this exemption and to not have to actually report anything to the public because I'm some small company that shouldn't have to report any information or provide any transparency or any open access. And they have malfe they, again, I go back to the Franklin Templeton example where their initial listing was hundreds of pages of SEC disclosures, an extensive amount of public information about exactly how every aspect of it worked. And here we have a one-page template that I mean, all it says is they paid 500 grand to securitize, and they're offering an unlimited amount. It's an open-ended fund, and they can sell it to as much institution as they want for the next year as it's registered with the states.
Is it more of an experiment that they're trying to do to get into certain new asset classes that they weren't tapping into, which is the retail front on blockchain? Is that like what the aim here? I mean, these are speculations, but what do you think?
Yeah, well, retail's not buying BUIDL.
No.
Retail can't access BUIDL. And retail, frankly, can't hold BUIDL in most instances. And in the vast majority of cases, they throw the word blockchain in like it's some magic unicorn, but the assets are sitting in the vast majority of circumstances on a central exchange because how are you going to trade it otherwise? How are you going to transact with it otherwise? It's just not possible without the orchestration they have that is so deeply interwoven with these central exchanges. And that's why they do it through this transfer agent that offers this central ATS. It's this regulated central intermediary that charges these 1% fees and can manage the securities just like a private Form D placement. And by doing it that way, it is exponentially easier than the material public scrutiny over a true fund filing. And more particularly, the extensive work required to actually tokenize the underlying asset instead of just some wrapper on it that gets thrown in a custody chain. But for me, the largest thing with it is that it's so clear that there are billions at stake on certain chains, and namely Ethereum, that are just sitting there inactive. And it's just an opportunity to extract that, put it in a vehicle that charges fees, and package it as something you can sell to institutions. And now you have a less regulated environment to give it to them. You have a they say it's decentralized, but they just put it in these central exchanges. They have more control over it because now it's not sitting at DTC. It's not sitting at a custodian. They get direct access that Fed window, and frankly, they have the direct ability to determine the future of this direction. While they say they're a leader in the space, but in reality, it's operating on a chain where you're paying $20 every single transaction. That's never going to scale in a decentralized. I mean, at least presently, with the existing technology in a decentralized manner that allows for the equitable trading without a central intermediary, which, as I established last time, is something I feel so foundational to a long-standing capital system. Trade is the essence of capitalism, and that just doesn't happen on these legacy networks.
Right.
They are great at other things, but just that one aspect, they don't have.
But so then people would say, well, it's trading on Ethereum, which is a public ledger. It's auditable, it's verifiable. So then, John, why are you so anti-BUIDL if it's sitting on a public blockchain ledger, Ethereum, right? And you're saying it's sitting on a centralized exchange. Please explain to people, what do you mean when it is on a public blockchain?
Sure. So I have these institutions, they reach out, and without going into too much, they ask us to build similar things. And so I dive into the nuances here, and I think the underlying premise is we're dealing with different languages across a lot of these chains. And, wouldn't it be easier if just for the finance side of things, just for the market side of things, and just for the basic payments infrastructure, we could all speak English, okay? I don't have to translate between EVM and actual financial systems that work on a scaling basis for the world in a decentralized way. Because for me, if you think about the long-term implications here, if we're going to put the entire economy on blockchain, there's so much money at stake there that for me it is inconceivable that that happens on a proof of work chain where again there's just so much at stake that even billions of dollars into miners would be a worthwhile attack. And similarly with these proof of stake chains nowadays, when you have trillions, so much money. I mean, it's quadrillions that we're dealing with it in the derivative scale here. When you put that on a chain where you can buy, stake, and then you can control that consensus mechanism through money. We are dealing with people that have practically unlimited money, and so how do we do consensus properly is the biggest thing, and I think that comes down to the groundwork for something that we can all use, and not just a select few institutions. because today when you're trading BUIDL, it's on chain, sure, but they're not trading on chain. They're trading off chain. The order book is really the most important part. This is the foundation of everything I do at wooten.link/thesis. The order book is not on the blockchain. The order book is on ATS, proprietary private exchange that charges you fees, central exchange that has you deposited in as custodian. And so when you make these trades between parties, that is held in every instance today. That is in the hands of a for-profit corporation. And these for-profit corporations, they charge listing fees, they pay rebates on volume, and they create all these malfeasances and conflicts of interest in the market. And you even see it on some dexes that are controlled by central groups of people. They charge listing fees, they pay these rebates that distort volume, and they segment the liquidity in a way that only hurts investors. So they'll trade on these proprietary exchanges, and then it's only a transfer. It's only, sending the asset from my wallet to your wallet that happens on chain. And so it's a two-step process. It's completely segmented, just like our existing securities infrastructure, where the settlement, the clearing is completely different from the actual exchange matchmaking process. And that introduces every problem we have today with naked short selling.
Yeah, yeah. I think I'm gonna rein you back in a little bit
Yeah,
here.
yeah, yeah.
I think that's very, very interesting what you're discussing here. But I want to use your time to really focus on the BUIDL side, because I think there's so much just there, and So I was asking you this question of public blockchain. So so like the contract is visible. So BUIDL contract, you can go. It'll be visible through any Etherscan if you want to go and check it out. So that is there. But what you're highlighting here is not visible is the way they trade. So that's sitting with the centralized entity.
Yeah, very short story. I know an exceptional developer who built their own algorithms to figure out which cloud provider Coinbase was using. And then they would go into that data center. They would use latency arbitrage to figure out which rack in the data center that the Coinbase server was on. And then they would get on the same Ethernet switch so that they could arbitrage and high frequency trade against the other centralized exchanges. And it's this challenge of having one place for the order book that puts an immense amount of power, an immense amount of centralization, and an unwarranted level of trust in something that in the long term has to be owned by the community. It has to be available to anyone on an equal basis, or we're just going to have the same predicaments of these dark pool, obfuscated, and delayed routing and reporting systems.
The market mechanics that you're mentioning here, the way markets function today, traditional finance, I think what I'm hearing from you is like you're seeing the same mechanisms are
Yeah.
moving to blockchain,
They
right?
are on blockchain.
They are. I
We've
mean,
got dexes with
right.
PFOF.
Yeah. Yeah. We discussed that last time
Yeah.
that they are on blockchain now, except DTCC function yet. I think there are no depository and clearance corporations yet established on that side.
Well, because you don't need one. You go bankrupt because it's obfuscated with a piece of code that runs in the background, right?
Right, right. But I think it's worth highlighting that those functions will be run by smart contracts in some shape or form, right?
Well, today those functions are run by these centralized exchanges. I mean, they're basically acting as the securities clearing corp
Yeah.
in the instance of their own proprietary ATS in this case.
That's true. That's true. So we wouldn't need any other central clearance corporations there. So why do they need BUIDL? Because I think this is where the use cases discussion I wanted to have. Because I think the use cases are not clear to retail, at least from my perspective. I wanted to ask you that, what could be the use cases? Because end of the day, you have to ask if someone is doing something, what's the reason behind it? So I'm keen to hear your opinion on what do you think is the reason behind doing this.
Well, again, I think the biggest reason is just extracting a lot of this latent value sitting on chain. There really is not a solid, widespread, known interest-bearing asset by a regulated custodian and an entity like this. And if you can tie it in early on as a staple in the ecosystem, now you create this proprietary framework where you expect that everyone sort of needs to build on top of what you're doing and leverage what you're employing. So it seems like an early move into this burgeoning Web3 space, but done in a way that is not up to technical excellence. It is not up to actual best standards, and certainly is not up to a blockchain designed for its users. Rather than, again, these systems, these smart contracts, they do amazing things if you want to do absolutely anything, and that's exactly what they let you do. But when we see the transfer agent on this instance using the same bridge between networks that was hacked a couple of years ago for hundreds of millions of dollars as this break like streamline example of the conundrum with these systems where you can do anything, they don't particularly specialize in the financial applications. And I think what we really need is an ASIC for the financial system, because it has a forcing function where now you have the trading in one place. And by having the trading in one place, you have the liquidity in one place. So now you're not arbitraging between all these different exchanges and putting your trust in the central authority that quite often has custody of your assets. Instead, you can have everything in one place that is owned by everyone, that is decentralized, and in every sense of the word, it gives the transactions directly to the users, so that there is only one place you need to go to. It has all the liquidity, it has all the orders, and it's just best for these specific applications of a financial system.
Right now we have so many different blockchains and blockchains that are built differently. But idealistic view of John is that a single blockchain that can do all these things and that are verifiable.
I love that there's competition between the chains. I think they all do very special things in their own ways and produce exceptional output for the industry. But in the specific application of these trading systems, one thing that comes to mind is a conversation I had with an engineer that built IDEX, which was really the first widespread decentralized exchange. And again, the focus here is on the people behind the project and them as individual sovereign actors building something stellar. And in that instance, after they got any kind of material volume and traction, very quickly, you get a knock on the door from the regulators. And it doesn't seem like we can have that trading functionality without a custodian, without risk of these rug pulls on the plethora of different custody solutions. When we don't have a way to get best execution, because when there are all these different chains, all these different trading venues, all these different segmented sources of liquidity, it becomes impossible without exceedingly large amounts of resources to find the best price on any transaction. You always have to compare, just like in today's markets, we talked last episode, you have to compare against these, hundreds of venues that you can transact at, all these different order books that are segmented. All of them are centralized today, and the only way to do that is to spend a very large amount of resources in aggregating everything. And when you aggregate everything, you gatekeep it. You put it in the hands of a select few middlemen, and you trust them to do the requisite routing. So yeah, if you want to have the most efficient market, if you want to rebuild the system in its most ideal form, you need to have all the transactions, all the orders in one place, so that you know gigantic institution A doesn't have any benefit over Nigerian farmer B when they want to bid against that same asset.
There is no blockchain currently, right? Like, we are a big believer in Caspa, and I know you are in Stella, right? There is no blockchain that can handle that type of volume, right? Because you're talking about massive volumes here that needs to come on chain. That I mean, can you think of something, any blockchain that can handle that type of volumes?
Yeah, so the Stellar Decentralized Exchange is a decade old, like most of the you know respected, long-standing ones that have had time and they've done over $20 billion of transactions on the native decentralized exchange. So you can sign a transaction in your hardware wallet today to put in an offer on an order book that's maintained by all the validators, and it works exceptionally. It just lets you trade directly with liquidity that is not on a central server. It is, in every sense of the word, every 5 seconds getting updated on a network wide basis. and they are pioneering research on how to do parallelism on the validator side to scale it up to the daily throughput of NASDAQ and the NYSE combined.
I'm an institution, I have $5 million plus. I go and buy these BUIDL tokens through Securitize. Now, what can I do with this, right? I'm there to get some yield. So I get, money market fund yields, whatever that may be right now. I think it's around 4.1, 4.2%. So I get that through treasuries, right? They're passing it on to me, my wallet. What else can I do with this asset? Because for me, this asset that was a dead asset perhaps before, now all of a sudden became active, right? And the way I thought about it, there are a few different use cases, but I want to hear your opinion as well. For me, the use cases are like, a lot of crypto projects have money, like they've raised money. It's all sitting in some bank somewhere, right? Now they can bring that over to this securitized and convert it to treasuries, well, tokens, this BUIDL tokens, which means you're buying into certain assets that BUIDL holds, right? While also getting some yield, which might be a yield you're getting already on the bank side because they end up buying this treasuries or whatnot. Um, Obviously, you can use that as a collateral. So other use case could be they're using this tokens against some collateral on a exchange or giving it to a market maker or whatnot, right? What are the other use cases you can think of?
Well, I love that you're looking at some of these cases and really diving in deep on key and with you there. When you talk about when you talk about moving from these projects that have money, and let's assume for the conversation that they've raised that money legally in a sitting in a bank account, which honestly is interesting. There's quite a few DAOs that literally just hold USDC and native tokens. Pretty incredible what you can do on that front. But let's say they have that money in a bank, and now you want to move it to this particular broker because that's what they are. They're a broker. You have to be a broker to run these ATS. Okay, we're going to move it from this bank to this broker, and this broker is going to put our assets in something that's custodied in an investment contract by this institution on Wall Street. Well, it's to me, Ankit, that sounds pretty damn similar to a bank.
Well, but it is. But I think I want to draw the distinction here, and that's why I'm highlighting that. I think, of course, it's similar to bank, and I highlighted that part as well. Bank will end up buying treasuries, which is exactly what you're doing here. It's interest bearing as well, which is exactly what you will end up doing here. It's interest bearing, and it's perhaps owned by the same central entity, right? Here it could be bank. Here it's Blackrock slash securitized, right? So I guess then the obvious question is why to go through this whole route? Is this to have quick liquidity? Because obviously to get money in and out of bank to a stable, it's going to take a while, right? But while you're sitting on the tokenized side, it's very liquid. It's convertible, easily into stables. So then the question comes down to it's all about the speed, right? Which is important for the centralized entities.
I think that you've definitely hit on the nail on the head here, Ankit. It's a question of speed versus guarantee, security, and faith in a system because these investment contracts are not FDIC. They do not carry any of the protections that you would expect from a bank. And if you transfer USDC to the wrong address, I have no doubt it's similar here, whereby you have to go through that central intermediary to make changes if you even can, because you don't have the protections so requisitely built into banking regulations that protect you against errors like that. They just don't exist. To me, it seems like this humongous risk, and for what? And for people that have a bunch of stables laying around that want to do these on-chain investments. I talk to these institutions, and at least over the past few years, they don't seem converted yet. They're still sitting on those assets in a bank account, anything at scale, sitting in a bank account because they want to preserve the existing banking system. They don't want to give this free hand back to retail, put everything in the blockchain and obviate their whole business models. uh, to think that there's some altruistic purpose, I mean, it doesn't seem like you're getting more efficiencies. I don't work at a multi-hundred-million-dollar bank. It doesn't seem like they're getting these efficiencies in a system where you need to pay these 1% trading fees, and what can you do with it except for transact it and move it in between a couple of select few institutions that will accept it? Because you can't send it to a random person's wallet address. They need to be whitelisted because of the very implicit KYC requirements. You can only send it to these other gigantic institutions. So for me, it sure seems like it's quite similar to the banking system. And honestly, is it that much faster than FedWire?
Let me push you a little bit here, right?
Yeah.
And see, so you're saying because it's not insured by FDIC, and it's a risk that you're taking. But isn't that true with anything crypto, anything blockchain, anything stables? None of that is FDIC insured, right? So what I'm saying is, yes, of course, if you're just take a use case of moving money from bank to this tokenized BUIDL asset, well, yes, speed is important for a lot of people. If you're, money manager, if you're, market maker, of course, you need money. You need capital sitting there, which is liquid, and ready to move at your disposal, right?
Well, I'm with you on the speed on Keat. I've had too many trades where you just couldn't get the money there in time. And certainly there are these custody risks, especially on the blockchain side, and especially with assets that aren't properly regulated. The difference I will posit here is that on the traditional blockchain asset, you've got that cryptographic security, and really the end risk is on the user for configuring their signers and keys properly. Whereas when you introduce these, I mean, we've got at least the broker and then the ATS and then the custodian of these shares. You've got at least three middlemen put in the fold here on this token. And if any one of these people mess up their job, and particularly if anything goes wrong on the traditional custody side, you are exposed to that risk just like you're exposed to Wormhole, which is the platform and the product that they use. And when something goes wrong, you have to expect a bail-in, like what happened with Wormhole, if you want the tokens to stay one-to-one back because they're not the true asset. It's not the actual dollar sitting on chain, and that's something that is quite possible. It's within the realm of existing regulations, and it just comes down to the hard work of actually implementing it in a system that applies and coheres with public policy instead of something that is frankly opaque and designed just for these institutions.
Yeah, yeah, I agree. I think, and one additional point that comes to mind is cross-border trade, right? Because in a banking system, if the cash is sitting on the bank, you can't do cross-border very quickly. Again, sort of linked to speed and regulation, right? This perhaps allows you to be very quick. Again, goes back to speed, but can do cross border without needing to go through wait on the banking system. So that's another one just came to mind.
Well, yeah, but so do stable coins, and you're not trusting a central intermediary to give you that interest payments in a system that is. I mean, I just I'm not. What's the difference there? The thing for me, and let me know what you think. By all means, push back. But again, it's this institutional product versus something that's actually usable. Because who needs cross-border trade more than anybody? It's the tens,
It's
hundreds of
institution.
millions of people doing remittances.
Yeah. Well, yes, but also institutions, right? Like if you're in a, if I agree with you, but I think the trade is global trade. I don't believe that we live
Yeah,
in a
global
world,
trade.
right? I don't believe we live in a world where money is just moved by retail. I think institutions, market makers, banks, constantly moving money in and out of countries, right? So I do think they need speed as much as retail does. But but it's interesting nevertheless, right? And but the third use case that I was specifically thinking was that they want to use this asset that's on chain, perhaps. Yes, it is through some centralized entities, but it can be used, I think, to be used as a collateral, right? While the money isn't sitting in the bank, might not be able to use quickly as a collateral if they need capital for capital requirements, which are changing constantly. So, do you see that as a use case as well?
Well, for me, the question comes back to whose money are these institutions holding in the first place? And if you and I can really hold our assets on chain in our own name, what purpose do these institutions serve in the first place? As custodians, as aggregators. And sure, maybe there's a couple of central bankers that are going to make a lot of money off of this because they can lend out assets that are already being lent out from the government. I mean, you're just hypothecating again and again. And who does that benefit? It puts the money in the hands of a select few. Sure, great, okay, and maybe they'll give you a little bit on the interest. But um, I hope, sure, that it helps these pension funds, but I know that it's not really designed for that. It's designed. You can sort of see by you mean you're adding basically a new derivative on an already existing lending product being treasuries. And a new derivative is a bad thing. It's a very bad thing.
Bad thing from different perspective, right?
Yeah,
Retail,
for retail.
right? Retail perspective, decentralized. Because I think my job here is I'm trying to take both sides,
Yeah,
right?
do it, man.
And I'm trying to say, well, if they're a use case, right, we can't deny these functions. We can't deny the way market operates, right? And what I'm trying to build here is a story that right now the way this product is built to be used by institution, and there are obvious use cases there, right? Outside of interest bearing asset, outside of being able to have quick, speed, there are other use cases. So, but yes, I agree on the retail front. They are not. It's not truly transparent. I mean, technically, retail can't access this. It's not built for retail for now, right? So I don't even think it's worth discussing that asset, for retail because it's not built for retail. So that's why I just wanted to focus on the how it's built and why it's built and how it's sort of supposed to move around that system, which is for centralized entities, for institutions. How do you see it evolving? Do you think the we think that the ceiling is very high for certain things like this, right? It can go right now it's sitting at $500 million. It can go to billion, 10 billion, 100 billion. I don't know the cap. Uh, and can it be only for institution? Can it be for retail? Will it come for retail? We can all speculate, but what do you think where it's moving?
Yeah, well, I'm with you, Ankit. I mean, obviously, it's a free market, and we can't control what smart contracts people deploy on the world's computer. And I appreciate that they're using it as a testing ground and building out some history and helping people understand it. I wholeheartedly. I mean, do you really think this is the financial system that we need? I remember I opened a broker account at SoFi when they offered crypto assets and invested in a number of assets, that I truly believed in. And within, a few months of going through, depositing the money, putting in the shares, they closed my account. They stopped offering that service. They sold every asset I had. And unfortunately, that seems to be quite the common story with these institutions where they really can't bother to manage your account unless you hit some threshold. And this is something I saw over and over again. I tried to open a dozen forex brokerage accounts to do to trade some of the things we talked about last episode, and they all say no, 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 you don't have the capital, you don't have the access, you don't have enough for this to be worthwhile for us. And I fundamentally disagree with that approach to capitalism itself. It is unacceptable that we bar, in this case specifically, we bar the vast majority, the 99%, from accessing this product. And even if it was available to everyone, if they went through all the right regulations, even if they made it available on an IPO, for gosh sake, you and I, if we're trying to do this every week in our paycheck, we can't afford the expenses, the charges, the inefficiencies inbuilt into ETH if you don't want to accept the centralization of the L2s.
Because you've gone through this, and we discussed this in the previous episode, your personal journey you went through and why it's sort of you take on this challenge of building block transfer. But I think where we slightly disagree, because I want to make it interesting for everyone, is the place where I think market, at least from my perspective, I think market needs to be transparent. The data accessibility needs to be open to everyone.
Yeah.
But I think in terms of fees, I'm okay to accept that. Okay, there are fees built in. I think if you're obviously trading a bigger account, and it's not just on the capital traditional market side, right? If you're doing a commodities trade, right? If you're dealing with 100 tons versus 1 ton, of course the rates will be different. So I understand when you have bigger accounts, the commission goes down. They don't want to deal with the smaller accounts. So I do understand those challenges, as these are real companies that have shareholders and they want to make money. They're for profit. So I do agree, but I think where I we both align is this is this place where, when certain data accessibility is not available to both sides, so retail and obviously institutions, I think, and we both agree on that, could agree on that, that the data should be accessible equally to everyone.
I'm completely with you on open and transparent, available to everyone. But what I have seen paging through thousands of pages of these, I mean, really diving deep into the current market infrastructure, if you actually look at the regulations, they name for-profit LLCs that act as, for instance, the SIPs that report the data of today's stock markets. And I've seen over and over again that a for-profit exchange, a for-profit information distribution, I mean, there's so much information you can only find on Bloomberg. And that only exists because there are for-profit corporations behind every single one of these exchanges. And I wholeheartedly believe that if you want to give people the best tools to empower them to build real savings and retirements, then it can't be through a they. It can't be through this corporation that's extracting rent, that has a profit motive that goes up and to the right and is worth billions of dollars. And instead, it has to come from that protocol integration, the protocol level, and the real ownership promised by Nakamoto that you could have your own keys, that could be all you needed without that central intermediary. And that's something that fundamentally reshaped these markets in a way where, sure, you're going to pay, very minimal, is necessary as possible to prevent spam. There's going to be that network gas, okay, but I just there's that base protocol layer, and then there's the actual user interface. And as soon as you introduce, as I've seen, is and you introduce a profit motive in the middle there, and it just distorts it to the challenges that we have today. You look at the origins of the Dutch East Indies Trading Company. The sole reason that it evolved into centralized exchanges was because the transfer of stock was impossible. It was $200. You had to go and sign paperwork. You had to walk to the office together. It was just, you had to physically go, and it was just horrible. But we have this incredible new technology that lets you and me send between each other with the click of a button. And that enables all this functionality on top of it that can be done through protocol level trading, be done through smart contract level derivatives, where there is no for profit, there is no intermediary whatsoever.
Yeah, you're very, very passionate about this topic, and I think and we agree, we align on all of that. I've been intellectually thinking, right, debating with myself. Is BUIDL, right? It's built, it's up and running for the last 6 months or so. It's got liquidity there, 500, 600 million. Wouldn't that be additional liquidity for the treasury market? Let's assume right now it's 100% is going to treasury markets. Wouldn't that actually create additional liquidity for treasury markets, which is the most liquid asset on the world, right, on the planet? It's the most liquid market. It is the most liquid asset. So are we saying that this BUIDL has obviously a lot of use cases for institutions, can be used different ways, provide extra speed? Now, it has another sort of feature, which is to provide additional liquidity for the most liquid asset. As the BUIDL grows, and more people come in, more institutions around the globe come in, they will be accessing the treasuries indirectly, easily, perhaps. And the point you mentioned earlier in the episode, that that when you tried to get into treasury market, it was very hard, right, for you to access. But this provides that frictionless access to the treasury market for the rest of the world. No?
Yeah, I'm with you, and it circles back to that access point. There is a real conversation to be had about how good is it that we want the world buying our national debt and inflating our currency. But aside from that,
Aside from, I think that's a different topic for a different day. But I'm just saying, in terms of the trade side, in terms of volume.
well, what I think is that the vast majority of money that's going to go into U.S. Treasuries is already going into U.S. Treasuries. I mean, it's not retail, like we just said. It's not retail buying U.S. Treasuries in the vast, vast, vast majority of circumstances. It's central banks, it's countries, it's entire nations that need somewhere to put their, because the dollar is presently the standard that we all use for trade. And so to think that we're gonna put this asset on chain and a nation state is gonna use that to somehow access our treasury markets in a way that they're not accessing it before, that seems silly to me. They're already directly bidding because you're not getting that direct bidding, okay, right? So people don't know the treasury market's an open rate, daily cap interest auction. And so you can actually bid up, you can bid for the best yields, and that's something that anybody at scale is going to want that direct access. If you ask me, is my
No,
and
that's fair. Yeah.
so what new capital are you going to be funneling into treasuries with this? If we agree that the vast majority is already at the central banking system. I mean, we're trying to bridge central banking government debt with decentralized blockchain, and those are very different things. And I think
Mm.
it shows in that you can't buy this asset. I can't buy this asset.
Let's imagine a world here
Yeah.
that it is for retail, right? It moves this thing from institution to retail, KYC, all the right ways that the centralized exchanges allow you to do it, right? Now at retail, let's assume the treasuries in China, for example, right? JGBs or whatever that may be, right? In Japan, they are actually returning 1% yield, right? And if a individual retail, just like we can access the capital markets, the stock market in US retail through brokers, right? This could allow the retail from rest of the world to get into the US treasuries and access yields that are perhaps higher than their own countries, right? So we're not talking about central banks here. I'm not talking about banking system that already has access and can bid on treasuries every day, basically every, I think, 3 times a week or whatever the number is. I'm talking about retail over time, right? 6 months, 12 months, 24 months. Once it opens up to retail, it gives access to a lot more people that can get into treasuries. That's what I was thinking.
The Franklin Templeton one is the case study I'd show because it does have that retail, and it has been growing, but they've also faced, as I understand it, growing challenges and have been moving a little bit away from the most efficient, most cost-effective product for those end investors. And I think the conundrum here is that as soon as you start to design for those, small saving retail users across the world that you're right, they don't have access to these things, and even just giving them a stable coin is a market benefit to a lot of their natural currencies. And so giving them on-chain yield in a way that's regulated is a market benefit over their existing fiat systems. Um, the quandary for me is that now you have a very significant cost. It costs, I'm sure you've seen this, DRSing shares from abroad, there is real compliance cost for every new name that you put on the list of investors. And for me, when I see this operated by a for-profit corporation, custodian, and broker, to think that they're going to make their systems so easy to use that anybody can buy 5 cents worth of it when it costs $15 to KYC them,
Mm.
it's a little silly. It's like, okay, well, come on. I mean, why can't I open up name your broker and then put that person in Africa? And it's nearly impossible.
Knowing that it's built on Ethereum, right? The transaction costs are high. Of course, it's $20, $30. Is for a 10,000 or 20,000 or $5 million transaction, asset transaction, it doesn't really cost much, $20, $30. But if you're moving $5 and paying $30, it obviously adds up.
Yeah, I'm with you on Keat, and surely people will point to the L2 arguments and, oh, you can just scale it with centralization. But then what's the difference between that and that person putting the 10 grand in a bank? And I'm sure with 10 grand, you can get some exposure to foreign assets. I think these systems really need to be designed. I think we should all be on the same playing field. I don't see any reason why a rural Kenyan farmer can't invest in the same assets as Ken Griffin. There doesn't seem to be any purpose in doing that other than to perpetuate a plutocracy, to perpetuate a government where this oligarchy controls every asset and the direction of our society and can form it into these dictators that rule our world. And because that's centralized capitalism on key. You're putting in all this money, all this capital in the hands of a select few institutions, and they dictate every corporate governance policy. That just doesn't seem. I mean, that's not a world I want to live in.